Good morning, good afternoon, everyone, and welcome to today's webinar. My name is Tom Wickling. I work for the IAIS as a Senior Policy Advisor, and I'm very pleased to be your host today. So thank you for joining us. Today's session will be focusing on the IAIS's newly published Guidance on Transitioning to a Risk-Based Solvency Regime. This publication and today's accompanying webinar are very timely, as many jurisdictions look to develop or enhance risk-based regimes. And we believe that this will be very useful for supervisors, policymakers, and stakeholders alike. Over the next hour, we'll hear from the leadership of the IAIS's Risk-Based Solvency Implementation Forum, that's the RBSIF for short, who will present the guidance. And following the presentations, there'll be time for questions to the panelists. So before we get started, a couple of housekeeping points I'd just like to raise. Firstly, attendees' microphones have been muted by default. That's to minimize background noise and ensure we get good quality listening experience. If you do have any questions or comments during the presentation, please use the chat box that's available at any time, and we'll be able to see that. At the end of the presentations, there will be an opportunity to request the floor and to speak directly to the presenters and ask any questions that you have. Please also note that today's session is being recorded, and both the recording and the supplementary supporting materials will be available to participants on the IAIS website. If you do run into any technical issues during the webinar, please don't hesitate to message me or the support team using the chat box, and we will help you as best we can. Now, I'm very pleased to introduce our distinguished panel of speakers today, who bring a wealth of experience and insight to today's discussion. First, we have Justus Steenberg, who is the chair of the RBSIF, and he's also an actuary at the Prudential Authority in South Africa. Secondly, we have Suzette Vogelsang. She's the vice chair of the RBSIF, and she is also a senior financial sector expert on insurance at the International Monetary Fund. Finally, we have Peter Windsor, who is the lead drafter of the guidance and is also a senior financial sector expert on insurance at the IMF. So we're very grateful to have them with us today, and I'm looking forward to a very informative session. And with that, let us begin. And I will now hand over to Justus, who will give us an introduction.
Thank you very much, Tom. Good day, everybody. It's nice to have you all online and joining our webinar. It is my very much big pleasure to present to you today our guidance on transitioning to a risk-based solvency, or as we call it, RBS, an RBS regime. This topic is at the heart of ensuring robust, fair, and stable insurance markets that protect policyholders and contribute to global financial stability. This, of course, is very much at the heart of supervisors and therefore also very much at the heart of what the IAIS does. Today, we will provide you with an overview of the document that we drafted, which we believe can be very helpful for jurisdictions navigating this very complex but quite rewarding process. I thought maybe just to also mention at the top of our presentation here that this document is not supervisory material or an application paper, terms that our members might be quite familiar with, but it's merely a help or an assistance to readers, mainly IAIS members, but could also be other stakeholders, with, of course, our main target market or specific focus is on EMD members. Next slide, please, Tom. Just to start, I would like to give you an overview of the IAIS as it pertains to the work that we did recently, and really highlights three key aspects of the IAIS. I suppose there could be some others as well. The one is that the IAIS is quite committed to two overarching goals. One is to promote effective and globally consistent supervision of the insurance industry to develop and maintain fair and safe, stable insurance markets for the benefit and protection of policyholders. So that's really the heart of the IAIS. And then also to contribute to global financial stability. As part of its members, the IAIS has represents really 200 different jurisdictions, and collectively they account for almost 100%, 97% of global insurance premiums. And by the sheer number, you can see that there's, of course, not just the major markets, but really many other markets also. The third aspect is that the IAIS collaborates with other international standard-setting bodies, such as the Financial Stability Board, and also serves as a platform for supervisors to share knowledge, experiences, best practices, and particularly through initiatives like this one, the Risk-Based Solvency Implementation Forum, and other fora, it serves to do so. Okay, but let me turn to the forum that I chair, the RBSIF. The next slide, please, Tom. So this is an initiative, this forum, really initiated by members and then processed and with good support from the IAIS. But its design was to support jurisdictions, particularly the EMDEs, but as we noticed through our journey, other jurisdictions also do have benefit from it, as they transition to an RBS regime, or risk-based solvency regime. Our forum had two primary objectives. One was to develop practical guidance, and I like the word guidance. It's not any of the other things that I mentioned before, supervisory material, application paper. It's also not an instruction manual. It really is just practical guidance for supervisors. Our focus was, of course, supervisors and particularly EMDEs, but we do understand that other readers will also have a look at it. But the guidance is to focus on practical aspects of implementing an RBS. And we present this document today. Of course, our mandate will also be include some other drafting of other documents. And then very importantly for a forum is to facilitate peer exchange. So this forum served as a flexible peer exchange platform, enabling the members of the forum to share experiences, challenges, and approaches as they also implemented an RBS regime in their jurisdiction or is in the process of doing so. The forum also provides a good space for discussions on technical aspects related to such implementation, such as capital adequacy, governance frameworks, and disclosure requirements. And I like the arrow between the two. It's always important that the peer exchange that we do have kind of leads into the documentation that we want to draft, and sometimes vice versa, where we wanted to draft documentation. We could go back to the forum and get insight from our members. Next slide, please. So let's dive a little bit into the guidance. We call the guidance on transitioning to risk-based solvency regime. This document is organized to serve as a practical tool for supervisors embarking on the journey to implement an RBS regime. It is divided into 6 key sections, each building on the previous one and covering the key aspects of a transition process. Let me explain the highlight of these 6 sections before the next presenter will go into more content. So as you can see, section 1 really sets out the foundation of the objectives and the scope of the guidance. Section 2 answers the question to some extent, what is RBS and why implement it? Here, the document explores some core elements of an RBS regime. Those would be typically the quantitative, the qualitative, disclosure requirements, those things, while highlighting its objectives, such as policy protection, policyholder protection, sorry, and financial stability. Of course, there's some sections also about the advantages and costs of implementation. Those cannot be ignored. In section 3, we look at some general considerations. This section focuses on the market environmental factors that influence the design and implementation of an RBS regime. Section 4 goes a little bit into some practical aspects, experience of the members of the forum, and definitely some others that has been on this journey, is that transitioning to such a regime is quite a long project. We say medium to long-term project, and therefore the project management practical things are quite important. Section 5 is the only one where we really go into some level of the technical details, and Peter will delve into much deeper depth there. This section focuses on quantitative, qualitative, and the disclosure requirements of such a regime. Then in section 6, we have what we call a summary of the case studies that we have from members and forum members and other IAIS members. Just to give a bit of a feel or a taste of the members that have gone on such a journey before, to see what what they've experienced and what their actual environment was like, and before and after. We do have a set of full case studies that we have as an annex to this guidance. This is only available on the members extranet though. As I alluded to before, I will now hand over to Suzette to delve into some deeper content of the document. Thank you.
Thank you very much, Joost, and good day, everybody. I will be covering section 2 and 3 that Joost had just explained. So risk-based solvency is a comprehensive framework that ensures insurance maintain an adequate level of capital proportionate to their risk profile. Now it integrates 3 key components. One, the quantitative requirements, which focus on financial soundness, meaning that insurers must hold sufficient capital to withstand risks such as underwriting losses, market volatility, or operational challenges, and that ensure that they can meet their obligations under adverse conditions. The other component is qualitative requirements, which addresses governance and enterprise risk management, where insurers are required to adopt robust frameworks to identify, assess, and mitigate risk effectively, ensuring sound decision-making at all levels of the governance structures. And then the third component is the disclosure requirements, which promote transparency, and it requires insurers to disclose detailed information about their financial health, their risk exposure and governance frameworks, and it fosters trust amongst policyholders and market participants. Now, the rationale for implementing a risk-based solvency regime is key for the efficiency and sustainability of the insurance sector by enhancing policyholder protection. It supports market development and it contributes to financial stability. Now, at the next slide, you do find various stages of capital calculation in a risk-based solvency regime. And this diagram reflects the progression in sophistication. So it allows jurisdictions to adopt approaches that align with their market maturity and their supervisory capacity. And let me just briefly explain these different stages. So at the bottom is the fixed capital requirement. So it's the most basic level capital requirement, which is the absolute amount in local currency. It's a simple approach, but it does not account for an insurer's individual risk profile. At the second level is the greater of approach, and here the capital is determined as the greater of a fixed amount or a percentage of key metrics like a percentage of net premiums or claims reserves. Now, while this is slightly more risk sensitive, this method remains limited in its ability to reflect the full spectrum of risk an insurer is exposed to. The following model is a factor-based model. So different factors are applied to assets and liabilities to calculate the risk-based capital. Now, this approach provides greater granularity and it begins to account for the specific risks insurers faces. The fourth one is a factor-based plus model. So this builds on the factor-based approach, but it incorporates diversification and correlation benefits. It offers a more accurate reflection of risk exposures. The next one is a stress and factor-based model. So this is a combination between stress scenarios with factor-based calculations built into the capital calculation. And this captures more complex risk interactions. And then the most sophisticated model involves insurers using either a supervisory approved internal model or standard capital models provided by supervisors. These models are tailored to reflect the insurer's specific risk profile, enabling a more precise capital adequacy assessment. Now, this progression throughout the 6 models allows jurisdiction to scale up their frameworks as expertise and capacity is developed. In implementing a risk-based solvency regime comes with significant advantages, but it also requires careful management, cost, and challenges. Now, let me start off with the benefits or the advantages. So, implementing a risk-based solvency regime does incentivize insurers to adopt more sophisticated risk management practices, and it fostering a culture of resilience and long-term viability. It also aligns with global best practices. A risk-based solvency regime enhances the robustness of jurisdictions' regulatory framework and could open opportunities for additional investments and international businesses. The risk-based solvency regime ensures that insurer holds sufficient capital. This balance supports competitiveness while maintaining financial soundness. And the framework also facilitates close interaction or integration between macro and microprudential supervision, enabling regulators to identify systemic risk and intervene proactively. But moving to a risk-based solvency regime does come with potential costs. This includes supervisors that need to skill up themselves, so they need to enhance their resourcing by appointing additional personnel. Robust IT systems and adequate funding is needed to implement and oversee the risk-based solvency regime effectively. Both supervisors and insurers may need to restructure their organizations to align with the RBS requirements, such as establishing new governance frameworks within the insurers or within the supervisor recruiting specialized staff like actuaries or risk management experts. Transitioning to a risk-based solvency regime also involves a steep learning curve for both supervisors and insurers, so training and capacity building is critical. And with all the additional data collection, the additional analysis and reporting that comes with a risk-based solvency regime, supervisors and insurers may need to upgrade the IT infrastructures. While the initial cost of implementing a risk-based solvency regime can be significant, the long-term benefits such as market development, policyholder protection and financial stability can far outweigh these investments. Now, when you transition to a risk-based solvency regime, jurisdictions must consider a range of factors so that they can tailor the framework for their unique circumstances. And these considerations are critical for ensuring a successful and sustainable implementation. Now, factors to be considered, and from this picture on the screen, you can see we've sort of linked the various capital models that I explained earlier with the factors, and now one then can transition throughout the models based on the particular general considerations. Now, if you've got a stable fiscal and monetary policy, that provides a strong foundation for a risk-based solvency regime. But where the jurisdictions has less stable conditions, a phased approach may be more appropriate to avoid overburdening insurers and supervisors. The sophistication of financial markets influences the design of a risk-based solvency regime. For example, in jurisdictions with limited financial instruments, they may face challenges in valuing assets and calibrating risks. Demographics and culture is also a consideration. Culture, attitudes towards insurance, and levels of financial literacy impact product demand and market development. So in jurisdictions with low insurance penetration, risk-based solvency can foster trust and transparency, supporting market growth. The nature, size, and complexity of the insurance market can inform the level of sophistication required in the risk-based solvency framework. Simpler markets may start with basic requirements, while complex markets may need advanced risk management tools. The supervisor must also assess their resources and capabilities, including its actuarial accounting and IT expertise, and how it will build capacity in implementing its risk-based solvency regime and deciding on what level of sophistication it will start off and how to mature over time. Now, these considerations can assist supervisors in deciding whether and how to go about the transition. There is no one-size-fits-all approach to a risk-based solvency regime, and jurisdictions are encouraged to design frameworks that take into account their local economic, market, and supervisory conditions. With that, I'm going to hand over to Peter to take you through the practical aspects. Thank you.
Yes, Suzette. So implementing a RBS regime is a medium to long-term undertaking. We say around 5 to 10 years is a reasonable expectation. It requires careful planning, strong governance, and sustained engagement with stakeholders. So let's break this process into the three components: the project startup phase, project planning, and implementation stages. First, the project startup phase. This is critical because it sets the foundation for the entire project. It begins with defining the scope of the project, which includes identifying gaps in the current solvency regime and setting realistic objectives for the target RBS regime. And that links back to the last slide that Suzette presented. Securing endorsement from senior management within the supervisory authority is essential. It ensures internal buy-in and provides the strategic direction needed to drive the project forward. Additionally, government buy-in and endorsement are often required, especially if legislative changes are needed. Early engagement with policyholders can help secure the necessary support and resources. Finally, a dedicated project team should be established. This team should include individuals with expertise in risk management, actuarial science, IT, and project management. And this is something that we find is often lacking because of resource constraints in EMDE supervisors. This will cost resources, and therefore a dedicated project team is an important aspect. Next is project planning. A well-defined project plan is the backbone of a successful implementation. It should include clear goals, timelines, and milestones. Risk assessment is another critical component, identifying potential risks such as resource constraints or resistance from stakeholders, and allows for the development of mitigation strategies. And a communication plan is also essential. Regular updates to stakeholders, both internal and external, help maintain transparency and build trust. And we emphasize this throughout the paper, that communication with the insurance industry is key to a successful project. And then we have the implementation stages. There are multiple ways to structure the implementation of an RBS regime. Jurisdictions may choose a conceptually led approach where the initial consultation focuses on the objectives and design of the regime, or a legislation-led approach where the legal framework is established first and technical details are added later. Another decision is whether to adopt a phased approach where components of RBS are introduced gradually, or what we call a big bang approach where all the elements are implemented simultaneously. Throughout the implementation, field testing and parallel runs are key. These exercises allow supervisors and insurers to identify gaps, refine processes, and ensure readiness before full implementation. The practical aspects of implementing RBS are complex but manageable with proper planning and governance. So now let's look at some examples of these different ways of going about the project. Next slide, please. Let's look at the consultation-led process, which is a collaborative and iterative approach to implementing RBS. The method prioritizes stakeholder engagement from the outset, ensuring that the framework is both practical and aligned with market realities. The initial consultation begins the process with a conceptual consultation where the objectives, form and technical basis of the RBS regime are consulted with stakeholders. This consultation sets the stage for the project by building consensus on the goals and principles of the regime. Next is developing technical standards. After the initial consultation, the focus shifts to the development of technical standards such as capital adequacy requirements, governance frameworks and disclosure obligations. Multiple rounds of consultation are typically conducted to refine these standards based on stakeholder feedback. Field testing and parallel runs are integral to the consultation-led process. It allows insurers to test the proposed framework and provide feedback on its practicality and impact. Parallel runs where the new RBS framework is tested alongside the existing regime help identify and address any operational challenges. And then there's finalisation and implementation. Once the technical standards are finalised, the framework is implemented in stages. This phased approach ensures a smooth transition and minimises disruption to the market. This consultation-led process is particularly effective in jurisdictions where collaboration and stakeholder buy-in are critical to success. So let's now look at the legislation-led process, which takes a more top-down approach. In this method, the legal framework for RBS is established first, with the technical details added later through regulations, guidelines, or standards. So the first thing is drafting the legal framework, which outlines the broad principles and objectives of the RBS regime. This draft is then subjected to consultation, allowing stakeholders to provide input on its scope and implications. Again, it's absolutely critical to have the stakeholder buy-in all the way through the process. Then there's finalising the legislation. After incorporating feedback, the legislation is finalised and enacted. This provides the legal authority needed to implement the RBS regime. Then there's developing the technical standards. Once the legislative framework is in place, the focus shifts to developing the detailed technical standards. These standards are typically introduced through secondary legislation such as regulations or guidelines and are subject to further consultation. And again, field testing and implementation processes are required. Field testing and parallel runs are conducted to ensure the framework is practical and effective. The final implementation is carried out in stages, with supervisors monitoring adoption and addressing any issues that might arise. This legislation process is well suited to jurisdictions where a strong legal foundation is necessary to drive the implementation of RBS. So another aspect that we can go back one, please, is that we can also have a phased approach to developing the requirements. So, for instance, one could start with something like ORSA, and then develop into some of the other requirements, like the capital requirements. Next, please. Finally, let's consider some examples from the Insurance Capital Standard or ICS. Now, I think it's important to say up front that the ICS was developed for complex internationally active insurance groups and is unlikely to be suitable for straight implementation for EMDEs. However, it provides valuable examples of risks that can be addressed in a risk-based solvency regime, offering insights for tailoring frameworks to local markets, including for emerging markets and developing economies. So, for instance, let's look at some insurance risks. For insurance risks like mortality and longevity, those are addressed in the ICS through stress scenarios. So, for example, the ICS applies a 12.5% stress factor for mortality risk, and non-life risks such as premium and claim reserve risk are calculated using factors applied to net reserve. So what could be done in what you could take from this is you could develop a factor-based approach based on learnings from the ICS. I think what you can take from the ICS is the risk categories, and then whilst the risk management might be more complex, that can be simplified into something like a factor-based approach for EMDEs. So, for instance, looking at market risk, this includes interest rate risk, where the ICS applies stresses to yield curves, and equity risk, which includes stresses like a 48% decrease for emerging market equities. So In the case of interest rate risk, the modelling of interest rate risk through stress scenarios may be more complex than can be implemented in an EMDE. So one thing that can be done is net exposures may be broken into different duration buckets, and factors might be applied to net exposures in different duration buckets. And then finally, catastrophe risk. So the ICS employs a stochastic modelling approach to address low frequency, high severity events. For EMDEs, where such models may be unavailable, a simplified approach like an uplift to existing factors for insurance risk may be appropriate rather than the full stochastic modelling approach. So these examples highlight how ICS principles can be used to inform EMD efforts to addressing key risks in their markets. So I'll hand back to Joost for the wrap up.
Thank you, Peter, and thanks for that as well for highlighting a bit more detail about what the document, what you can expect when you read the document. So as we close this session, this discussion today, I would like to emphasize the potential of transitioning to a risk-based regime. RBS is not just a regulatory framework, it is really a comprehensive approach that attempts to integrate quantitative, qualitative, and disclosure requirements to strengthen the resilience and stability of insurance, and therefore also the insurance industry. One of the key takeaways that we found during the drafting of this document is that RBS promotes a risk-aware culture, both for insurers and the supervisors. And that's why we're also very happy that we have this very public document that more than just supervisory stakeholders can read it. This RBS, that is, ensures that insurers hold adequate capital to withstand financial difficulties, while also fostering sound governance and transparency. This framework is adaptable and can be tailored to the unique economic, market, and supervisory conditions of each jurisdiction. However, transitioning to an RBS is not a quick fix. It is a medium to long-term journey. As Peter said, more 5 to 10 year type of journey. We like to say, think months, don't think months, think years. And it requires careful planning, sustained effort, and strong stakeholder engagement. Early buy-in from all the many stakeholders, including government, supervisors, and the industry, is absolutely critical to building consensus and maintaining the required momentum. As we've seen, there is no one-size-fits-all approach. I think we've said it before today, but very important to understand that jurisdictions must avoid a copy-pasting type of exercise where a model from an advanced market or any other market is used and then just pasted into the local jurisdiction. And our document sets out a lot of these thoughts, and that jurisdictions should instead focus on practical adjustments that align with their local context. As explained also, perhaps to start with simplified approaches, perhaps with an ORSA, or maybe basic reporting, and then scaling up over time. It really is very dependent on each jurisdiction's conditions in the broader sense of the word. What we also found is that collaboration and communication are at the heart of successful RBS implementation. That's part of the project management bit. Engaging stakeholders throughout and using consultations, field testing, and other channels builds trust and ensures that the framework is both practical and effective, and proper buy-ins from all stakeholders also. RBS implementation also involves significant learning process, requiring investments in training, technology, and capacity building to support transition. For emerging markets and developing economies, the key is to balance market development goals with policyholder protection. RBS offers the flexibility to design frameworks that support innovation and growth while maintaining financial soundness and stability. It's no use having a nice framework, but really disturbing the market too much. It's a proper hand-in-hand process. This IAIS guidance provides a wealth of practical considerations and real-world examples to support jurisdictions on this journey. However, these are not rigid rules. They are tools to help jurisdictions adapt RBS principles to their unique context. As we'll always like to say, it's not an instruction manual with rigid rules, but really a guidance just to help in this journey. Ultimately, the goal is to build a resilient and inclusive insurance sector that protects policyholders, supports economic development, and contributes to global financial stability. It can also include there to build the insurance industry. Remember, the transition to RBS is not just a regulatory requirement. It is an opportunity to strengthen the foundation of your insurance market for years to come. In conclusion, I would like to just mention what we intend to do going forward. This journey for ourselves is also not near the end. And of course, the IAIS, as part of its broader mandate, will always continue to support jurisdictions in adhering to supervisory frameworks, and in this case, their journey for improved or increased RBS transition. The forum, the Risk-Based Solvency Implementation Forum, will still delve deeper into key aspects of the transition. And here I would like to extend already an invitation as readers of the document notice particular area that they think deeper aspects or deeper delving would be quite useful, to please contact us for us to consider that. Supervisors will also have access to tutorials and resources through the BIS Financial Stability Institute's e-learning platform, the FSI Connect. And as I always like to do, for those IAIS members that's interested in joining the RBSIF, we still have a lot of work to do, a lot of exciting discussions. I encourage you to reach out to the Secretariat for further details. We're now at the end of our session, but now we're open for any Q&A that our Secretariat will help us to facilitate.
Many thanks, Euster, and also to Peter and Suzette for the very interesting presentation there. As Euster said, we're now opening for questions. We've got about 20 minutes left on the session. So please, if you do have a question, please write in the chat that you would like the floor, or you can post your question in the chat itself. Currently, we have one question in there. It's from Carlos Arocha. Maybe, I don't know if Carlos would like to ask his question himself. You can unmute him. Carlos, would you like to ask your question? I can see you unmuted. We can't hear you at the moment. Okay, we don't seem to have the connection yet. I'll read out the question. It's, what is the criteria for a jurisdiction to be classed as EMDE, so emerging market developing economy?
Maybe I'll take that one. So this is a classification that's included in the World Economic Outlook that's published by the IMF twice a year. So I'm sorry I don't, off the top of my head, remember the exact criteria, but you can, if you go to the WEO, you can see the countries that are classified as EMDE and the criteria.
Thanks, Peter. That's very, very helpful. Okay, we'll move on to the next question in the chat then. It's from Etahal Olotaibi. I don't know if we can unmute. Would you like to ask your question? I believe the microphones are open, so you should be able to speak to the panelists. Okay. In that case, we maybe have some technical issues, but I'll read out the question again. So the question is, Based on the experience of IAIS member jurisdictions, what transitional rules have been implemented to support insurers in meeting risk-based capital requirements? For example, allowing insurers up to a year after full implementation to achieve full compliance with the target solvency ratio. So it's examples of transitional rules.
Maybe I can take that one, Tom. And I want to apologize. I understood my camera was not working while I was speaking, but I hope it's all sorted now. So different approaches from members. One approach for full compliance, that I'm aware of, was to have parallel runs prior to implementation. So allow companies to apply both the proposed risk-based solvency regime and the current regime for a year or two, to ensure that by the time the regime goes live, that the companies are ready and in compliance. Other approaches was to postpone the introduction of certain requirements within the regulatory framework, or allow historical elements like capital instruments to be counted for a period of time, so a grandfathering provision, although in the new regime it's not fully or allowed as all. So different approaches from different jurisdictions that apply. Thanks.
Many thanks, Izzy. I hope that answers the question. Just give a chance in case anyone wants to come to Hal would like to come back on that. No, okay. We'll keep trying to open the microphones. We seem to have not being able to currently get people to speak, but we'll keep working on that. We've got the questions on the chat though, so I'll keep reading through them. So the next question is from Shalina Visram. Shalina, can I ask you to speak? Hopefully it'll work this time.
Yeah, let me try. Thank you very much for this session. I'm just curious, for those regulators that oversee cross-sector industries, as well as in insurance companies that do business and across the sectors, how would you suggest the RBC regime be implemented? Would you suggest sector by sector, or appreciate some comments? Thank you.
Many thanks for the question. Who would like to use that?
I've got it. Thanks. And thanks for the question, Shalina. Yeah, so this is one of the matters that it's discussed in a way in the document, and that is really for a jurisdiction that wants to go in this transition to an RBS regime to really understand first what they have in their market, and then to approach the way they design and develop their framework accordingly. If you have a market where there's lots of different sectors in it, that would be a good example of why such a jurisdiction should not copy and paste from another market where it is perhaps more in fewer sectors or only in one sector. But definitely to keep those type of things in mind, I would think that the purpose of RBS regime is really for financial stability and protection of policyholders. So I would think a industry-wide framework is definitely more preferable than, say, one that only looks at a specific sector or subsector of the industry, insurance industry. Where there are particulars where they do have other financial sector also exposure to those, then those must be clearly understood, and to see how then a framework for an insurance company should be built based on that fact. One could of course borrow from those other financial sectors themselves. They typically have something very akin to a risk-based solvency regime often, but best of course to develop the whole market then in piecemeal format, so that there's not a other arbitrage type of scenarios picking up, or an unbalanced framework for the whole sector.
Thank you. Yeah, appreciate that.
Sure.
Great, thanks. Next question we have is from Ernaline Hernandez. Ernaline, are you there? And if so, would you like to?
So
If not, I'll read the question. It says, can the IAIS assist in implementing RBS in small jurisdictions? That's the question.
So I'll let the IAIS Secretariat also complement my answer here. Of course, is that the IAIS is very much at the heart, needs to support all its members, not just the bigger members. So it's definitely have a lot of initiatives and approaches how they address the needs of EMDE. This forum being a very good example of it, very topical example, of course. And drafting this document is exactly an attempt to do so. There are a number of other fora, and I know we also have a vice chair for our executive committee that looks at EMDE. So supporting them, EMDE, as much as they can, of course, is therefore at the heart of it. Of course, it's limited to what they can do. The IAS cannot go into a jurisdiction and build a framework for that jurisdiction, but otherwise, you know, from as being a standard setting body, the IAS is that's kind of where their mandate stops. I'm not sure, Tom, Carlos, if you want to add to that.
No, that's a good answer. You think it's true. Exactly. The IAS tries to provide as much material and support as we can, but we can't go into a specific jurisdiction and sort of help directly one-on-one with an implementation. It's more a toolkit and materials that we can provide, and for us, as you said, for people to learn and to especially to share knowledge and experiences with others.
If I could
maybe just to add, then also, sorry, Peter, we do have implementation partners. That helps in helping all our IAS members adhere better to the ICP principles. So those organizations are also very useful and helpful for in this case then EMD members in implementing an RBS regime. Peter, yes.
Yeah, I was just going to say that there are organisations that provide technical assistance. We're one of them. The IMF, the World Bank is another one that provides one-on-one assistance, and there are other technical assistance partners like the Toronto Centre that can help.
Great, thank you very much. Okay, I think we'll move on to the next question. It's from A355696. I don't know who that is, but I'll open up if they would like to speak and introduce themselves at the same time. Your microphones are muted if you'd like to ask your question. No, we don't seem to have them coming through. Okay, I'll read the question again. So, for a jurisdiction which has many subsidiaries with various foreign insurers, which approach is suitable?
Maybe I can try to give it a stab, but Peter and Jooste can come in. So, I mean, we would propose that while you're building your risk-based solvency regime, that you start enhancing your data collection over time, you know, and you know, extend your reporting requirements so that as a supervisor you're able to collect the data needed through the process. That's one option. The other option is to start off, for example, with the ORSA process, rather than implementing the whole capital requirements at the start. And you know, as the ORSAs are developed and as the supervisors are analyzing it and seeing what type of data insurers are reflecting in their own risk solvency assessments, then start collecting those data and build up your data collection over time to assist in the calibration and determination of your capital requirements. But maybe they're actually in the room, or Peter, that's well very familiar with capital standards, can add. Thanks.
Yeah, I think the only thing I'd add is, you know, where the owner of a company sits doesn't really impact on how you develop the solvency requirement. It's more the characteristics of your market that should determine how you develop the solvency requirements. So whether the ownership sits within your jurisdiction or outside your jurisdiction shouldn't particularly matter for a legal entity level capital requirement.
Thanks, Peter. I think our question has struggled with the mic as well, so we'll move on to the next question. The next question is from Dr. Usman Yankara. Can I ask you to ask a question? The microphone is now open. Unmuted. Yeah, again, don't seem to have the audio there. So the question is, how do you manage and navigate the data challenge in emerging markets, especially given the extensive specific data required for risk-based capital? Anyone would like to give that a shot?
I would go, Tom. I mean, I think really building on what Suzette said already is that it is very much data-driven. Dr. Usman, I agree with you. But calibrating a framework or designing, deriving a framework, you need to have the right data. And I think that's partly why we would often say that this journey is not something that happens very quickly. It really does take many years. And I don't think it's something that should be rushed. Getting enough data or sufficiently enough data of good quality does take some time, and I think that would be the process. Maybe one of the first steps that needs to be taken together with, of course, good stakeholder buy-in is to get the right data. Make sure you understand what data you would actually need, what can be provided by companies, maybe in the short term, medium term, and long term, but then to really work on getting the right data. Without data, it's really a flying blind type of exercise. So it's a good reason why it does take a long time. And of course, getting the data is one thing. Really analyzing and understanding what the data tells you is a whole different ball game. But that's what I would suggest you to do.
Thanks, Easter. If there's no response, we'll maybe go on to the next question, which is from Marzan Kirsten. Marzan, are you there? And if so, would you like to ask your question? Okay. I mean, I'll read it out. It says, perhaps an unfair question, but roughly what percentage of global jurisdictions have already implemented RBS? One for the number of people.
Yeah, I don't know if my IMF colleagues have a feel for that number. Actually, don't think we actually do know that. What I can tell is that from our members of the forum, we have a number that has been on this journey before, a number that is still planning to go on this journey, and a number that actually is on this journey and not quite implemented, but busy with a 5 to 10 year type of project. And having an implemented regime is really not the end of the journey. What we found in the document, and I think it comes through the reading of it, is that there's always more to learn, new things that one can try, things that one can fix, perhaps even some going as far as to say that. But it's really is a journey. It's not a one destination. Even if you've just implemented it a few years after, it's a good time for review. Also, so it's quite something that seems to continue. But yeah, I don't have a number for actual percentage. No, thanks. Sorry, Marzan.
Thanks, Heath. It was a good response to that question. So next question is from Falak Sumro. I don't know if Falak can like to ask the question.
Unmuted.
Haluk, are you there? Would you like to?
Sorry, hi there. This is Falak here. My question was basically, I have two questions, in fact. First is there any source that I can use for calibration exercise on the underwriting and the market risk? What is the IAIS's recommendations? Second question was the interaction between operational risk and catastrophe risk in terms of the interaction, and whether to use stress tests or scenario tests to determine the operational risks, or go independently.
Thanks for the question.
Yeah, thanks.
Who would like to try to answer that?
Well, I know there were calibration papers that sat behind the ICS development, but I'm struggling to remember whether they're public.
I believe they are.
Yes. Okay. So I think that's probably from an IIS position. That's probably your best source for. Again, it's in the context of internationally active insurance groups, so that's always an important caveat when looking at the ICS. But that will give you a sense of how certain risks can actually be calibrated. So I think from an IIS perspective, that's probably your best source. And I think that probably answers the next question to some extent as well.
Yes, I think that's right. Yeah, the question from Abdul Moid is very similar in that. So what sources of data available at the IAS that can be used to benchmark. So that's right. I mean, obviously there are other jurisdictions and other will have produced their own calibration information, which will be specific to them, but it might always provide useful guide, helpful information or sort of give guidance on how to go about certain approaches. But obviously, you have to be taking the context that that's developed for a specific market. Okay, in which case we maybe move to. We've only got a few minutes left, so we try and take one or two more questions. Unfortunately, we've got a lot on the chat. We'll get through as many as we can, but unfortunately, I don't think we'll get through them all today. We have a question from Dr. Winell Delandro Robinson. Would you like to ask your question?
Yes. Hi, good morning. Can you all hear me?
Yes.
Yes,
Yep.
you can.
Yes. I just wanted to build on the question by Ms. Ram, who just now, when she talked about, how to implement the different regimes. But I know that when we were implementing IFRS 17 in the Caribbean, some companies that operate regionally were not implementing it. So is there some way, or what do you suggest for people who have that conflict and who will still be on the RBS regime with their supervisors and some will migrate to the RBC regime with other supervisors in their jurisdiction?
So we do have a section describing a little bit this type of scenario to some level, because for certain regions they are quite interlinked and kind of almost interdependent to some extent. And there it's I'm hesitant in saying it because it's like I said, it's not an instruction manual at all, but it really would be very useful if the region would coordinate in some form or manner what is happening for that region. I'm from South Africa, so we have a similar type of aspects, but there's a bit of a disparity in the sophistication or balance of and maturity of markets within the region. So sometimes it's useful to have one jurisdiction to lead, and the others then will definitely seem to follow soon thereafter as more learnings come across, and they kind of seem to go across borders by themselves. But that would really be the manner to do. Maybe to reiterate what Peter said before is that for a supervisor, the most thing they need to be concerned with is the stability of their financial market and the protection of their policyholders. So to some extent, that should be probably one of the drivers. But with understanding, and I think this is also mentioned in our section 3 about general considerations, that this is something that the designers of this framework needs to understand, is that they are part of a broader regime where the cross-border business and the companies having subsidiaries in other countries, neighboring countries, is a reality, and that could have an impact, and that's something they would need to consider and take into account when they develop this framework.
Thank you.
Thanks, Issa. Thanks for the question as well. We're running in very short of time now, so maybe we have one very last question before we close out, and that would be from Bernard Okpo. If you'd like to ask your question. Bernard, are you there? If not, I'll read out the question. It says, what would you advise? What would your advice be for a jurisdiction to address historical data gathering challenges?
Might take that one. So the individual insurers in your market will have their own historical data. So one of the things that you can do is actually do a data call from the insurers, and of course the insurers will keep their data in various formats for their own use, but you might issue standardized templates to gather that data. I do understand that publicly available data can often be scarce in emerging markets, so you do have to access private data in order to calibrate some of these risks. So the insurers themselves are probably your primary source.
Thanks, Peter. Okay, well, with that, I think we've run just slightly over time. So I think it's time we wrap up, and I'd just like to say thank you very much for everyone for attending. I hope you found it as insightful as I have. And many thanks to the panelists for the presentations and also the answering all these questions. I think it's been really, really helpful. So I see there are a number of questions on the chat. If you do have questions you'd like, you can always maybe contact the Secretariat and ask them to us. We will try and get an answer to you. Alternatively, there are lots of other fora in which you can sort of engage with the IAIS, the Global Seminar, the Annual Conference, and other events, regional and global ones, where you can engage with us and the RBSAF team to learn more and hopefully to help you move forward on your path to an RBS regime. So with that, I'll say thank you again, and we're going to stop recording now, and I wish you a very pleasant rest of your day. So thank you very much.
Thank you. Bye.